Welcome everybody. Thank you very much to all of you who are here and listening and watching at home for joining us for the Andrews Property Session Landlords of the Future Roundtable discussion. We're joined by a panel of experts who will be discussing a whole range of subjects. They're all experts in their own particular fields, so they'll be able to bring a whole breadth of experience. We're going to be discussing mortgages, finance, the property market, tax, and of course Brexit. Property is always a hot topic. There've been many changes, and it's really important that all of us keep up with those changes, and that's what our panel are going to be helping us with this evening. But it isn't just landlords who are interested in all of this, it's everybody, because of course we've got this historic debate coming up in, vote coming up in just 28 days from now on June the 23rd. So we want to know what Brexit potentially, or staying in or leaving, means to the housing market. Many of you have posted questions already. Any of you who are at home will have an opportunity to get involved, and we'll explain how that's going to happen. And there's also going to be a Q&A later on. We have the results of our first question. Thanks everybody for being quick and interactive. So the first question is, are you a landlord? And very interesting answer is 53% yes and 47% no. So clearly what we've got is a mixture of people who I guess are either landlords or particularly interested in becoming landlords, but we're going to find out a little bit later what people feel about that. So if you could go on now to the second question, we'll get a little bit more of a sense. But in the meantime, while you're doing that, I'm going to introduce our panel for this evening. So Michael Robson is the Group Chief Executive of Andrews Property Group, one of the largest independent estate agents. He's a fellow of the National Association of Estate Agents, a director of the Property Ombudsman Association, of the Property Ombudsman. He's been in property for 40 years. So that's Michael, welcome. David Westgate is the Managing Director of Andrews Letting and Management. He's worked in the residential sector for 30 years and has been MD of Andrews Lettings for the last 19 years. David oversees branch and corporate lettings for the business. The team have some 10,000 rental properties being managed in the UK, and David is ultimately responsible for applying UK legislation and policy in the front-end business at Andrews. Paul Bumford is Financial Services Director. He's the Managing Director of Andrews Mortgage Services, having been in the financial services sector for over 30 years. Paul brings a wealth of mortgage and insurance experience to the table. And last but by no means least, Karen Press is a tax specialist at Smith Williamson. Karen has been working in private client tax for 20 years and joined Smith Williamson in August 2015. Karen's experience is wide-ranging, and she deals with income tax planning, capital gains tax planning, inheritance tax planning and property tax planning, mainly for individuals. So, years and years of experience to help us all here this evening. Okay, so we found out about the panel. We're beginning to find out a little bit about the audience, and we're now going to find out more. So let's have a look at the next question, which is, what sort of landlords are you? The answer is, very interesting, 60% of people who answered are experienced landlords. Wanting to find out more, 20% are first-time landlords, and 20% are interested in becoming landlords. Okay, so that's good for us to know what sort of guests we have with us this evening. Okay, we can now ask for the third question, which is about how many properties people own. That's the last little bit of information, be really useful for us to have, which is how many properties you own. If you could do that one now, and then we'll get started with some of the questions. Okay, the answer hasn't come up yet, so it'd be interesting. I'm guessing, we could guess, couldn't we? I'm guessing that most people are in the lower bracket, which is sort of 0 to 2 or so. I haven't got the results of that poll yet, but we might want to move on actually, give people a little bit of a chance to answer that one. So what I think we'll do is come to our first question. Okay, so our first question is about the EU, inevitably. So I'm going to start with Michael. The question is, what impact is the EU referendum likely to have on the property market? Nice general question to get started with.
So good evening. I suppose this has a before and after answer, doesn't it? So before the referendum, there's no doubt that what we're seeing is a little bit of a slowdown in activity. For most people, buying and selling properties are one of the most complicated and biggest decisions they're going to make in their financial lives. And I think these are always governed by certainty, uncertainty, confidence in the economy, confidence in jobs, security, etc. And I think that before elections and a referendum like this, I think uncertainty always grows. Uncertainty affects confidence, and that affects people's confidence in making these very big decisions. Second part of the answer, in or out, we don't know. I think whatever happens, research shows that if we vote to stay in and there's continuity of the status quo, I think confidence will return very quickly. So I think we'll see the market pick up quite quickly. If we vote out, research shows that where there's a large change in political climate, confidence takes quite a long time to recover. So I would say we'll probably see a slower recovery, perhaps over a 2-year period.
Okay, good. David, anything you want to add to that?
I mean, I'd largely agree with Michael. It's essentially about confidence. Over the last number of years in the property industry, whenever we have a general election or referendum, there's always a lull before that point in time. But actually it bounces back pretty quickly depending on the result. So even last year with the UK general election, there was a lull before that period. But actually within 2 months, 3 months, the market had picked back up again.
Paul?
Well, that depends whether it's going to be in or out. It depends where you cast your vote. At the moment, the impact is pretty minimal. And as my colleagues have said, in previous elections, that market picks up quite quickly afterwards. It's amazing how resolute the British public are. They just seem to take off and deal with things as things happen. I think, irrespective of what the vote is, the housing market probably won't be affected in the long term.
Okay, I'm going to pick up now with sort of broadening the question out. So we've also had somebody who wants to know, and I'm going to ask you this question, will the EU provide a better business platform? So if we stay in, do we have a better business platform?
Well, the fact that we're already in the EU means we do have a good business platform. I was talking to some people earlier. We've probably got 2 generations of people who know nothing else other than the EU. So their businesses have grown up on the EU. So if you ask those people, they would say that the EU already is a good platform for businesses. Will it be better? Who knows? I don't think anybody can answer that, but I don't think it's been built and designed to be worse. You know, everybody has different opinions. You know, my personal opinion is actually we're not in a bad place. The UK mortgage market is very good. Money is available. Is that down to the EU? Is that down to the fact we've got a relatively okay economy? Who knows, you know? But I would say we have a good business platform at the moment.
I mean, if we left, do you think mortgage rates would change?
Mortgage rates have always changed. So if I just go all the way back to when we joined the EU, people need to remember we have had good times and not so good times within the EU. Interest rates have been low, interest rates have been high. I think some people in the audience will remember when interest rates were 14, 15%, you know. That was when we were under the badge of the EU. If we come out, I suspect we will have a short-term hike in interest rates, but as always with the markets, they find their levels. Everything finds its levels. Whomever is in power, they're not going to run a mortgage market or an interest rate market that is unsustainable for the British public. So I think it'll find its level.
My view on that is I think property investment by its very nature is long term. So I think, as we'll talk about later, you know, this is not a short term game anymore. And I think if you look at commercial property investment, particularly in central London, that's definitely slowing down at the moment because of uncertainty. So it's back to this question again about long-term certainty where you might choose to invest. In my view, certainly with residential property, for medium to long term, it will remain a good investment irrespective of a yes or a no vote.
Sorry, go on.
Sorry, see, just picking up on that. Demand always outstrips supply in the UK. So unless, whether we're in or whether we're out, unless successive governments start building oodles of houses, the housing market for investors will always be good in the long term.
Yeah.
Moving on to lettings, we've got a question about, you know, the impact of leaving on lettings regulations. What's the likely outcome
Well,
of this?
I mean, I don't know if people know, but at the moment in the UK, there's currently 750 different pieces of legislation that affect residential lettings, which is why you need to use a letting agent. So it's an absolute minefield. European legislation overlays that in a number of areas, but essentially European legislation is more about human rights. Specifically, UK legislation is more about how we manage property, how we rent property out. So again, I don't think there's going to be a fundamental change if we move in or out of Europe. That I think will be a level playing field.
Okay. Karen, everybody worries about tax all the time. So let's think about the tax implications. As a tax advisor, can you see any particular implications of either staying or leaving?
Obviously, after this year's budget with the change in the capital gains tax, I think trying to guess anything with this government is a little bit ambitious. So I think probably it's just trying to just retain where we are and just see where we are when something happens, really, and see if anything does significantly change. Will it or won't it? It's how long's a piece of string? So we just have to wait until the next budget, I think, to see where we are.
I'm getting the sense, one way or another, that all of you will be breathing a sigh of relief on June the 24th, whatever the outcome, because this uncertainty will be over. Is that the kind of general sense?
Yes, I think so, Anne. But I also think that we'll have to remember that part of the fun of the property market is that uncertainty creates opportunity. So I do think that it's possible, if you've got a strong constitution and the money to go with it. I think a little bit of uncertainty at the moment might not be a bad moment to take a punt, because I have my own personal view, and it is only a personal view. I suspect we probably will vote to remain in, and then I suspect the market will harden, and I suspect prices will rise, and they'll probably rise a little bit faster than we've perhaps been expecting, and therefore your punt, your bet, may turn out to be a very good one. So we have to remember that uncertainty creates opportunity.
Everyone's now just gone onto the Andrews website to find a property to buy.
You've got to have strong constitution.
Okay, great. So we're going to move on to tax questions now. So Karen, I'm going to start with you. One question we've had, this is quite long, so you have to listen carefully. If you own a rental property and want to buy a house now to live in, are you liable for the additional higher stamp duty on the new purchase that you plan to live in under new legislation that came in April?
Unfortunately, yes. I am aware of people, obviously they may have a buy-to-let for an investment and may not actually have a home of their own. They may still live with family, friends, rent because of work. But the legislation unfortunately does clearly state that obviously on that day, if you do own 2 residential properties, and own I mean having an interest, I think the figure used about £40,000 worth of interest in that property. So if you have a percentage share and the value is in excess of that, you do effectively have 2 residential properties and you will have to pay the additional stamp duty charge, unfortunately. Fun enough, I've looked at that this week for somebody, and I think ballpark for a property of about 200,000, the change in stamp duty is £6,000 difference if you are genuinely buying your home because you have a buy-to-let already. So for some people it can be quite a significant cost. The only thing to just add to that, if you do already have the buy-to-let, then obviously, when you come to sell the buy-to-let, you will get the stamp duty tax charge as a deduction for your capital gains. If you are in the position now where you're buying your main home, obviously, as we all know, when you sell your main home, there's no tax implications, so you will not get tax relief on the additional tax charge for the stamp duty if you are buying your home. So there's a slight crux there.
David, how much of the market is there? I mean, I wasn't really aware of this. So people are living at home with parents or whatever, perhaps because they can't afford to live in the house that they bought, so they're buying it as an investment, and then they realise that they have got the money, so they buy the second home. Is there a lot of that?
I think there's been a fundamental shift in the entire marketplace since 1988, when the rental market just changed overnight because of the ability to have more flexibility with renting a property out. As we all know, landlords can get mandatory possession at the end of a fixed term, and that fundamentally changed the market. So since that point now, there's something in the order of about 2 million landlords in the UK and rising. And the main reason for that is for their own personal investment strategy. But equally, people have to live somewhere. So jobs in the UK are now more mobile than they've ever been, which means that people might still rent a property and not live in it. They might live with mum and dad in London or somewhere and have a job somewhere else. And we call that the four-dimensional customer, because lots of us all have very different interests in property these days. So it's a very, very dynamic marketplace.
Okay. Karen, another question from you, which is about people who are not making their personal allowance, they're not earning enough. Will they still be taxed on interest payments?
If your income, your total income, including your rental profit as it's assessed now, is within your personal allowance, it's quite unlikely you will be hit by the new rules. We've got a lead in for a few years of them being phased in, but essentially it's going to hit the higher rate taxpayers. So unless you're in the position whereby your income currently is quite low, but your rental income is quite high, but the mortgage is quite high, you're very unlikely to be hit by the new rules. But with everything, you know, we've got a couple of years here, so it's always best just to get advice, just to check you're not going to be caught, or if you are, your potential exposure now, while you can still potentially look to see what you may do in a couple of years' time.
And there's a general question, which I think is, you know, this is of interest to a huge number of people, which is the general question about the impact of the tax changes on private landlords.
Yeah. This will be quite significant. I think in your folders there you've got a nice little brochure, and we will have it online for you, but there is obviously a big change coming, and 2021 is when we will all be in full fledge of it. It will hit higher rate taxpayers, obviously, as everyone is fully aware. What's probably less publicised is the extent that people could be affected. For argument's sake, if you have somebody who is a higher earner in a couple who currently has rental income, but their income is below the £50,000 threshold and they are claiming child benefit, they retain their child benefit as it stands. When we get to 2021, if the way that the income is accessible for rental pushes you over that £50,000, you will see a clawback in your child benefit. So not only are you looking at increased tax bill, you are looking at the child benefit being clawed back as well, in part, potentially. The same thing affects people that their income currently, with their rental income as it's assessed currently, are under the £100,000, so they get a full personal allowance. Everyone's entitled to that as it stands at £11,000. If the change in the way the rental profits are being taxed pushes your income above that £100,000 threshold, obviously you're paying your extra tax on your mortgage interest effectively, but also you're losing your personal allowance, and that is abated down. So it could be further costs to what you're actually anticipating. So again, it's just one of these things of just reviewing where we are now. You know, we have got a few years just to take stock, see where you are, look what your position is going to be like, and just be aware of where you are and any potential changes you can or may look to make.
I think looking at the bigger picture financially, it's a wonderful opportunity to look at refinancing opportunities that might come your way. But also the important point is making that this is not a short-term investment anymore. The days have gone where you could actually buy a property, sell it within a year and make a profit. This is now a medium to long-term investment. And if it's structured properly, you've got good tax advice, good mortgage advice, there's no reason why it can't continue to be an excellent alternative investment.
That was one of the questions, so I might perhaps ask Paul as well. So is the buy-to-let a good investment with the new surcharge and the tax changes? So what's your view, Paul?
Similar to David, I think you have to look at these investments as medium to long term. As I said earlier, the UK housing market traditionally has performed over the medium to long term. So my short answer to that is yes, of course it's a good investment.
Michael?
Well, obviously it depends what you're looking to achieve and why you're putting that money in and what else you could do with the money if you don't. So as my two colleagues have said, this all depends on how liquid or illiquid you want your investment to be. And what your personal tax circumstances are. But I would say that it's a pretty safe bet that investing in property for the next decade or so will turn out to be fairly positive, provided you've taken account of the other issues.
Okay. Karen, I'm going to come back to you. We've had a question which has been asked by several people in slightly different ways, so clearly this is an important one. The question is it worth changing those properties owned in a personal name, owned personally, to a limited company, and what are the associated costs and processes, or should these be left in a personal name and new ones bought in a limited company?
I get asked this quite a lot. The question is, it depends on your individual circumstances. There's no hard or fast rule. There's no, if you've got 10 properties, you should be in a company. If you've got 3, you should never be in a company. The main things to consider are, it is quite easy to set up a company, and the figures for this first quarter, I think there's been a huge increase in companies being set up, probably for properties. But there are costs to doing so. Putting properties into a company, there'll be a stamp duty land tax charge, there'll potentially be a capital gains tax charge on you as an individual because you would be disposing of a property. The other end, in a couple of years' time, you will get higher interest rate relief, obviously, because you won't have the restrictions, because it's only individuals. At the moment, that may possibly change. We don't know if the company position may well change in the future. So there's quite a lot of associated costs of doing so, and again, individuals may have different positions. And it's just what is the best thing for you as an individual going forwards. And obviously, aside from having the tax costs, you will obviously have the additional administration burdens for a limited company in terms of accounting, financial reporting and everything like that. So it's looking at everyone on an individual basis and not in that looking at the long-term goals. Like David said, it is a medium to long-term investment. So what are your goals? You could be sat here with 8 properties that are quite highly geared, but your long-term goal is to have 3 of them owned outright. Well, the company may not be the best thing for you, but planning ahead would be ideal.
Great, thank you very much indeed. So we've got a series of questions, as you can imagine, about letting. So we're going to start with Paul. We've got one here from somebody who says they've got one rental property, which they are self-managing, and they're in the process of buying 2 more. So what they want to know is, what are the benefits of using a letting agent? Can you give them any information about the pros and cons?
Well, I'm going to defer that to David, believe it or not.
I think that I could stand here all night and talk about the benefits of using an agency, but I'm sure you don't want to hear that. The most important feature, as I said earlier, is that at the moment there's around 750 pieces of different legislation that affect renting your property, which is phenomenal. So if you think you can do it on your own with no advice, good luck to you. The key benefit to using an agent, in my view, is really being your trusted professional advisor. We do know it all. That's what you're paying us to do. So ranging from everything from finding a quality tenant and referencing that tenant, showing the tenant around the property, to forming the correct legal paperwork for that tenant is really, really important. We did have some other questions about how do you get tenants out at the other end if they haven't paid the rent. Well, you can only do that if you've got the right paperwork in place at the front. So the key message really is using an agent gives you the huge advantage, the huge benefit of getting the rent right, getting the right tenant, getting the right paperwork, and ensuring ultimately you get your rent on time and actually you don't have any voids at the property. So as I say, I could go on, but the key features are around those areas.
I mean, in terms of so in a sort of general business sense, Paul, does it make it a more sort of professional transaction? Does it turn it from, I suppose, amateur to professional, and does that make it a stronger business proposition?
Well, picking up on what David said, clearly if you're going to go into business, you're going to let out houses and everything, you do need somebody or a company that knows what they're doing to help you over all those obstacles you couldn't possibly have thought of unless you're a professional. So yes.
Michael.
Yeah, and I'm going to answer this question from a rather unusual angle, that as Group Chief Executive, I'm the person that sees ultimately the most complicated complaints that come in. And David knows that some of these complaints are very, very tricky and very difficult. And the one thing that I can tell you from reading these over the last 20 or 30 years is that I would never want to do this without professional advice. I can see from the complaints that the level of complexity and difficulty that some landlords and tenants get themselves in could have been totally avoided if they'd taken a tiny bit of good advice right from the start. And it causes such heartache and such financial stress because they just didn't do it properly in the first place, and they come to complain later down the line and they find actually they didn't have the right advice in the first place. So my advice, use a professional.
I'll bring that on then to the question about the non-paying tenant, the problems. We've got a question which is about, should the legal system be getting tougher?
Well, it is. I'm going to defer to David because he is the expert, but yes, it's getting harder and harder, and the court's less sympathetic.
Yes, I think, in terms of the legislation as it sits at the moment, actually, we're in quite a good place. There's some good legislation out there, but you've got to get the paperwork right in the first place. The courts are totally overrun at the moment with all sorts of court applications. You can get mandatory possession for eviction or non-payment of rent. But where you can get unstuck is if the paperwork has been incorrectly served. So again, need to use the right paperwork and use an agent. The most important feature behind that, I believe, is good communication with your tenant, with the managing agent and with the landlord, and that's all very positive. But of course, the key feature, as I'm sure Paul knows, is that if you perceive renting your property out as a risk, there are insurances in place that you can take out at the start of the tenancy to protect you against loss of rent and damage to the property. And our best advice to you as an advisor is always consider taking out a policy at the start of the tenancy.
In general terms, and I'm happy to have everybody's views on this one, the buy-to-let is potentially something that can be used to political ends by any government to increase revenue when they need to, and everybody has a view about the buy-to-let system, whichever political persuasion they're from. So, is there a future in it? Is there a long-term future in it? Well, Michael, you can start.
That's a very complicated question, and we talk about this quite a lot ourselves. I mean, it depends which political persuasion you come from. There's absolutely no doubt that under a Labour government, I think we would agree that buy-to-let landlords are likely to get quite a tough time, aren't they, David? Yes. There was a lot of legislation and proposed legislation that was being stacked up, that if the Labour Party had won the election, would have been brought into play. And I think you would be ill-advised to decide to become a buy-to-let landlord or making buy-to-let investments without first reading some of that stuff and being aware of what was proposed. But I think better to let David pick up on that.
I mean, it's an excellent question, and my overview is that fundamentally we've got a housing crisis in the UK. We haven't got enough property to cover all forms of tenure. Last year, I believe we only built about 143,000 properties in the UK against a government target of 250,000. So we are way off where we need to be. People have got to live somewhere, fundamentally. There are massive affordability issues around living in places like Bristol and Bath and London, particularly for key workers. So people have to live somewhere. My personal view is that the buy-to-let brigade over the last 10, 15 years have actually done an excellent job about providing service accommodation for people that work in our towns and cities. Housing association movement has all but collapsed. They're not building any more property. Local authorities are not building any more property. People have to live somewhere. So, I believe that build to rent, any forms of building property for rental have definitely got a place in the UK. So I'm very supportive of all those sectors.
I mean, the main campaign, wasn't it, was by Shelter, really, and what they were really looking for was a fairer deal for tenants. What they wanted was longer leases, and they wanted a more public-orientated type of let. But actually, of course, you can have those, and they're not necessarily to the disadvantage of the landlord or the tenant.
And the problem with any form of government interference in a free market is there's always an unintended consequence. And in Scotland, 5 years ago when they brought in new legislation, the rents have all gone up by 20%. So actually the tenants have actually fared worse in that environment. Best left alone, in my view.
Okay. There's another question here about, do you know who is buying the properties and portfolios being sold off by landlords at the moment, and who will be buying them up in the next 4 years?
Well, it's an interesting question, and as far as Andrews are concerned, actually we have not experienced any exodus of landlords. In fact, quite the opposite. My internal KPIs and statistics show me that I've got more landlords this time this year than I had the same time last year. At the moment, we've got no landlords that are expressing interest in actually selling. So I'm a bit odds with that question.
Okay.
And I think everything we've said already, this is still an excellent medium to long-term investment.
Okay, great. Now then, rent caps. So what is your view on the potential rent caps that may be introduced by the new Mayor of London, Sadiq Khan, Could such caps deter potential PRS developers because of low profitability and therefore hinder further housing development in the capital?
Yeah, I mean, we're not sat in the capital at the moment. I've got.
That's a very different question.
Well, no, we've got branches in London,
Yeah.
so we know the market very well. I have enormous sympathy with housing policy in London. We were chatting earlier, and the average house price to buy in London is currently £543,000. So where do people live? So with the new mayor coming in, I think absolutely he has to have policies that bring in real affordable housing for the people that are service workers in London. It's essential. And back to the Brexit question, a lot of people coming in from Europe live in London as service workers. They need somewhere to live. So, I'm very positive about any policies that the new mayor brings in to bring in real affordable housing to the people of London. What that looks like, I'm not quite sure. We shall see.
I think this is a really good time to bring in the question of this market here in the west of England. So, I mean, what are the implications of an average house price in London of whatever it was, 500 and something thousand?
43,000.
Yeah. What is the particular kind of nature at the moment of the housing market in Bath, Bristol, the west of England?
I think what you're seeing is that because house prices have risen so fast in London and the home counties, I think a lot of buyers, both for domestic occupation and for investment, are starting to look outside London. And we know from the statistics that particularly includes places like Bristol, which have become extremely popular. And we talk a little bit, don't we, David, about the sort of disturbance factor and the fact that tenants are being forced to move further and further out of the cities because they can't afford the rents in the city of Bristol. So what you're seeing is that buy-to-let landlords are shifting their focus as well, not only to the cities of Bath and Bristol, Winchester, Oxford, very popular places, but they're also now looking at the commuter areas around those cities because the populations are being pushed further and further out to get value for money. So I think what you can say is that particularly for those very popular cities, I think they probably present excellent investment opportunities.
Similar to what Michael was just saying, everywhere is becoming more commutable. I mean, we were talking earlier about they're putting the electric line in, aren't they? And it's an hour Bath to London. Well, everywhere will be pretty much towards the south, will be in direct contact with London within possibly an hour. So it makes everywhere, as Michael was saying, if you live a bit further out, it's a good investment opportunity. You don't have to buy at the high prices in London. Britain becomes a much, much smaller country, housing-wise, in terms of being affordable.
I think one of the key strategies for investing in property is to go where the work is, because tenants, by their very nature, more mobile now, will go where the work is. And one of the key measures in our own industry is, of course, reducing voids, increasing rents all the time, and absolutely where the best properties are in the centre of Bath or Bristol, or even in this area in Keynsham, quality property at the right price never has a void. The demand for that property is colossal.
Karen, are there any particular sort of tax implications of the local market?
I mean, not really specific to the local market. It's all about, obviously, if you do buy a property for an investment, it's crucial you get tax advice. There's different ways you can look to own properties if you're married or in a civil partnership, which you can maybe look to maximise your basic rate band for one of you if that's possible. So if you are looking to make that sort of investment, it's just crucial to get advice really and long-term plans. If you've got specific goals over a certain period of time, good tax advice could mean the difference between it costing you less in the long run, as well as ensuring that at day one you know what it's going to cost you. Things like the extra stamp duty we've talked about, that's quite costly at day one, and just having the knowledge of where you're going to be going and your tax exposure and where potentially you can look to save, that is crucial.
So, I mean, if you had one piece of advice for a potential brand new, would-be buy-to-let landlord, as far as tax is concerned, what is it? Come and see you.
Yeah, come and see me. Are you married? Are you in a civil partnership? Are you a higher rate taxpayer? Is your spouse utilising their personal allowance or basic rate band? Because you can look to structure it so it's very tax efficient between a couple. So that's key one straight away. That can save you significant tax year on year. And just obviously having a plan, really, if you know what your goal is, especially if you're looking to maybe build a portfolio over a couple of years' time, what your plan is, because that could then determine what your actions are over the coming years. Do you go for a company? Do you go individually? Do you look to maybe, if you've got adult children, there's all sorts of things that you can look to do at day one, and just having a plan really and getting some advice on where you stand is a very good position to start, really.
I think having a goal and a plan for your investment is critical.
Yeah.
So I've got a number of clients that used to just work on a yield model only without reference to capital growth. Really now, with the tax implications that have come in, you've really got to look at capital growth over a medium to long term, which actually then makes a decision on which areas you actually buy the property. And as you say, if you can structure the tax efficiently at the front end, that's a much better way of doing it.
Okay, we've got a question about institutional investment. So whoever wants to pick this up. Do we think that institutional investment into student or build to rent letting will affect landlords?
I mean, my view generally is we're not building enough property in the UK. Now, I welcome everyone that comes in and builds, whether it's build to rent, student accommodation, private housing. It's got to be good for the economy, it's got to be good for our cities, and actually it brings in wealth and it brings in jobs, brings in opportunities. So I think anyone that wants to build, fantastic. If you look at cities like particularly Bristol, actually, that's had a huge amount of student growth properties over the last 10 years. Bath now is building something like 2,500 new units. What we're finding locally is it does not affect the private rented sector. For a variety of reasons, is a lot of students actually don't want to live in student accommodation after year one. They want to move into the private sector. And again, it's this big supply and demand feature. So at the moment, for every property we've got on our books, I've got 11 tenants looking at that property.
And the other issue, of course, is that this is all about the universities being allowed to attract more students from overseas. So actually what they're doing is they're providing accommodation, secure accommodation, particularly for first year, for overseas students. So they're just filling in with more and more overseas students. That doesn't reduce the demand for the second and third and subsequent years from more mature students.
Okay, we're going to move from tax to mortgages for our last couple of questions before we open up the floor, so get thinking about what you want to be asking. This is a question for Paul, I think, to start with. So what do you think is going to happen to rates for buy-to-let mortgages?
Well, not necessarily just for buy-to-lets, for all mortgages, and we'll probably go back to the first question you asked earlier about Brexit or not. Rates in the UK have been very stable for 7-8 years now. I don't really see that change, so I'll give you two answers for this. If we remain in the EU, can't see it changing at all. I suspect it will be very stable. Only something like a huge economic crisis, I think, will push those rates higher. If we come out of the EU, that will cause some disruption, and I anticipate the markets would react to the fact that we voted to go out, and I would predict a short-term hike in rates, and when I say a short-term hike, possibly for a couple of years. Now, what that would look like in terms of interest rates, I would guess it would probably move between 1% and 2%. Don't take me at my word for that, because I could be wrong, but that's what I think would happen. But the market couldn't sustain rate hikes of 3%, 4%, 5% for a long period of time. Just couldn't.
Anyone agree, disagree with Paul?
I agree with Paul. Good advice.
Okay, a question here about the Bank of Mum and Dad, which is an interesting one. How is it affecting the whole marketplace?
So I'll take that. So just for the audience, the Bank of Mum and Dad, that's us, means that if the Bank of Mum and Dad was actually a bank, it would be the 10th highest lender in the UK today. We all lend our kids £5 billion a year. That's a lot. But the good news is when they've got the house, you can go back and live with them to get your own back, you know? So, but there's a serious point in this, because traditionally, if you go back years, a generation was brought up on savings and saving for deposits for houses, so that's what people did. Nowadays, there's that many distractions for people for people buying houses, particularly first-time buyers. Savings isn't high on the agenda, which is why they come to mum and dad, because buying a house is a bit like buying a car for them, isn't it? You know, we'll go and do that. But where I think sometimes mum and dad go a bit wrong, myself included, sometimes we're a bit too eager to put our hands in the pockets for our children, when we should actually be pointing them in the direction of good advice from advisors, because there are help to buy schemes out there which, if they sit down with you as parents and speak to advisors, you'll probably find that the bank of mum and dad don't have to lend as much as they think they could. So my advice would be, go and speak to an advisor who has access to the whole of market, so you can see what's best for your children or for yourselves.
And that, Karen, is a point, isn't it, actually? You said a loan, and actually that's probably the wise thing to do, isn't it? Is to make it a loan to your children, which is actually repayable. And then you won't suffer some of the tax points, but Karen will probably pick that up.
I mean,
quite dangerous stuff.
Yeah. Obviously, you know, the bank of mum and dad, perfect. If you give them the money for the deposit, absolutely fine. You start then going in the realms of you buy 80%, I'll buy 20%, you're instantly in the 3% stamp duty levy immediately, because you have an interest in a second residential property, and that's not restricted to your 20% share, that is on the property purchase itself. So instantly increasing the cost at day one. And the main thing, obviously, for any gift or any loan is just for inheritance tax purposes, just keep a good log of it. If it's a loan, it should be noted as a loan. If it's a gift, it is a gift, but it does have inheritance tax implications potentially if you don't survive for 7 years. But again, you know, just take advice on that.
Okay, and we've got a general question here. I'm not sure whether this is aimed at buy-to-let mortgages or mortgages generally, but the question is, how easy is it to get a mortgage? Good question.
It actually is very easy to get a mortgage, providing you tick all the right boxes. So nowadays, it's all about affordability. You know, most people can get a mortgage if all the numbers stack up and it's affordable. The thing that catches people out is people who live off credit cards, for example, people who have payday loans or debts in the background, because it's not as easy as just rolling up to a bank or a mortgage advisor and saying, here's my income, I can get a mortgage for 4 or 5 times that. It's about whether it's affordable, not just when you take out the mortgage, but is it affordable in a year's time or 2 years' time or 3 years' time if interest rates go up by 1 or 2%. Because what the lenders are very, very keen on is responsible lending. What they don't want to do is be in a position in X amount of years' time, if the rates change or economic situation change, whereby people are moving into negative equity. So one of the reasons for higher deposits is, a few years ago, you might remember you could get mortgages at 120%, which I think Northern Rock were doing. So that effectively pushed people into negative equity. And that is a situation which is poor lending, which is not where you want people to be in the future. So.
Okay, thank you very much indeed. So we've whizzed through 45 minutes, which leaves us about 15 minutes maximum for your questions. So please, we've got some roving microphones, or a roving microphone. So we will ask you to put your hand up so we can get a microphone to you. We've got one here at the front. And please tell us who you'd like to answer your question, as well as what your question is. So
it's probably the lady, actually, because it's about tax, etc. I mean, I'm in a position where I've got 8 properties. I do interest only. Now, is it at the moment you pay your 25% up to the second tax relief, and after 43, gone up a little bit now, isn't it? You pay 40, but they're on about taxing the whole of the interest in the future.
What currently happens for you for your tax return is you have your rental income and you take off all of your expenses, which includes the mortgage interest, your letting fees, your insurance and everything else, and you come to a net profit, and that is then added to your income. You pay tax at the appropriate level.
You put your personal income and your rental income together.
Exactly. And then obviously if you fall above the 43, the amount above 43, you pay tax at the 40%. Now, what's being phased in over the next few years, and it is being gradually phased in, so I'll go to 2021, which is going to be the worst case scenario effectively. You'll do exactly the same for your rental. You have your rental income, you take off all your expenses except your mortgage interest. So your level of your income is taxed on your rental profit, effectively excluding your mortgage interest, and you pay tax at the appropriate level, then you'll get a 20% credit for the mortgage interest that you've paid. So for a higher rate taxpayer, so say all of your rental income currently is in the higher rate tax bracket, you're getting higher rate tax relief on all of your mortgage interest. By 2021, that will be cut in half. You'll effectively get 20% interest tax relief. So it can be quite a difference in your overall tax position. Your rents remain the same.
50, 60,000 a year in total, they'll be taxed it higher than 40%.
It will be, yeah, because you'll tax your total rents less your expenses, excluding your mortgage interest. So at the minute you're getting full relief for it. Whatever rate band you're in, you're getting the full amount of tax relief on your mortgage interest. Going forwards, you'll pay tax on your rental income excluding the mortgage interest and just take off your other expenses, and then come in at 20% tax credit. So it will hit 40% taxpayers, and it will potentially push people.
43,000.
Yeah. So say for argument's sake,
it's the same up to 40,000 and just
you pay.
After.
Yeah, you'll pay. Yeah. So say for argument's sake, your employment income is 30,000, say for argument's sake, and your rental profit at the moment, after all of your expenses, is 10. You're paying 20% tax on that profit. If that 10,000 is effectively made up of 20,000 of income, 2,000 expenses, and 8,000 of mortgage interest, going forward, your 30,000, you'll have 18,000 that you'll pay tax on. So you will have some in the 40% tax bracket, and then you'll only get a 20% tax relief for your mortgage interest. So it is going to hit a lot of people. And also, like I said before, potentially push people above the 50,000, which could count for child benefit purposes, push you of the 100,000 that could affect personal allowances. So the mortgage interest itself does have a charge if you are going to be pushed or already in the 40% tax bracket, but there's other implications on top of that as well. But it's not, I just want to stress, it's not immediate. We are, 2021. So like I do stress, there is time to look at your affairs, look at what your plan is. Exactly, it could change again. No one anticipated the change for capital gains tax this year. The rates came down unless you've got a residential property. So you just don't know, but working on what we know now and the fact that the government are in for quite some time, we just have to base our advice on what we know now and where we are. It could possibly change.
But taking the earlier point about tax planning, if property is owned by a husband and wife, and the husband is a 40% taxpayer, say, but the spouse isn't and isn't a taxpayer at all, there are mechanisms that you can change.
I haven't got one of those wives. I'm struggling to afford 8 properties about a wife and kids, right?
Yeah. So certainly, I think the message is to get some tax advice.
Take advice. That could cost more.
Okay, I'm going to move on because I think there are probably lots of different people. So thank you very much indeed for that. Another question. Yeah.
What's the best return on investment? Is it flats, houses, holiday lets?
Well, again, it rather depends on your goal and what you're trying to achieve. And again, whether you're looking at a yield or you're looking at capital growth. So you can probably today buy a property in the north for £30,000, a 2-bed house, and get a £600 a month rent on it, which will provide an excellent yield, but you're not going to get capital growth on that. So I think you've got to decide on what your typical goal is. I think, as Michael was saying earlier, for my money, I think you need to be looking at areas outside of the city centres that are within a travelling distance to the city centres, that have good communication links, because by affordability, that's where tenants are going to live, because that's where they can afford. And at the moment, there are certain areas where actually are pretty good value for money. But it does depend on your goals, really.
I was really thinking of the Bristol area. Like for like, our houses, do they generate a better return than
flats? Yeah.
Yeah, I mean, it really does depend, because in city centre Bristol, there's a number of my colleagues here that know better than I actually. But to buy a 2-bed flat in city centre Bristol at the moment is very, very expensive, and the return on that compared to the rent you get, whether it's a 2-bed flat or a 3-bed house, actually is quite a low yield. It's a low return. Whereas there are areas around Bristol you can still buy 3-bedroom houses, dare I say, for 200,000, 205,000, and get a rent of £1,000 a month. So your return is better initially, but the long-term capital growth is probably less. So again, you've got to really decide on what your objective is. We've got a number of Andrews staff here this evening, and if you've got specific interest in Bristol or Bath or local areas, I'm sure they can advise you later.
Thank you. Another question? Yes, at the back, sort of at the back, over in the corner.
Thank you. So I just bought a property in this year, April the 31st, or it was due to complete on April the 31st, and it didn't, despite me asking the solicitor to exchange before the stamp duty deadline, and they basically refused to do that and missed the boat. And so instead of paying £2,000 in stamp, I paid £9,500. Have I got any recourse?
Who would like to pick that one up?
It was the 31st of March was the deadline.
Sorry, that's
date.
what I meant.
Yeah. To be honest, that's a matter between you and your lawyer. I wouldn't know why they failed to exchange and complete. That's a matter I think you probably have to take up with them directly. I can't really advise on that, I'm afraid.
The only thing I'd probably
Well,
add is obviously
believe me, I've tried.
Yeah. Obviously, if it was a rental buy-to-let, obviously when you do come to sell that property, that is an allowable deduction for you for capital gains tax. So I do appreciate, obviously, going forwards now, it is costing more upfront for buy-to-lets in terms of stamp duty. But as it stands at the moment, if you sell them, you do actually get tax relief on the stamp duty, together with your, estate agents' fees and legals at the time of sale.
There's a little bit of a silver lining there.
Tiny bit.
Okay, is there one more question from anybody? I'm going to see if there's anybody who hasn't already. Yeah, there, already asked one.
Yeah, just one for Karen, please. Obviously, we've had quite a punishing time as buy-to-let landlords on the income tax side of things. Some very subtle sleight of hand, which obviously is clearly being shown to be quite punishing to your bottom line. Do you see any further changes, any further punishment coming down the line, possibly on the income tax side of things, or more worryingly, perhaps, on the capital gains tax side of things?
I'm hoping not. I'm hoping. Obviously, there has been significant change. The income tax, like I say, is coming in the next couple of years. The capital gains tax, I don't know if everyone's fully aware, but that didn't change in this year's budget. But if you sell anything other than residential property, then you've had your capital gains tax rate reduced. So it's been twofold really, the capital gains tax issue, the income tax issue that's coming, the stamp duty, land tax that's been increased. So I'd hope we've taken our fair share for the moment. And all I can really do is just say, we can only advise as it stands at the moment in terms of where we are. Will things change? Very likely. When that will be, I don't know. My main concern realistically is the number of people that may want to look to incorporate and rush into incorporation to think, well, I can save some income tax. And like I said earlier on, there are some tax implications on doing that. As it stands at the moment, companies do get full relief for their mortgage interest. Will that change in 5 years' time? Obviously, I can't answer that. Just to highlight really, I suppose, for everyone here, commercial property, your mortgage relief is not restricted. And also furnished holiday lets, I think that gentleman mentions there, if you've got a furnished holiday let, there's different criteria that you need to satisfy. It's not a long-term let, it's certain criteria. But again, that is the mortgage restriction is not on the furnished holiday let. So it may be that people who have portfolios that are still looking to expand may look to expand elsewhere. But like I say, we can advise on where we are now, where we'll be in 5 years' time. No one can really answer. It's just getting good advice to set you up as best as possible, and continuously having conversations to ensure that your affairs are structured as tax efficiently as possible under the current legislation.
Great. I've got one more question for each one of you on the panel, which will be a brief one. But before that, we have got the answer to the third question on the poll. This is really interesting. So the question was, how many properties do you own? And 38% of the people, this is obviously people here and at home, have a single property. 31% have between 2 and 5 properties. 23% have between 6 and 14 properties, and 8% have more than 15 properties.
Don't we wish we were them?
well, I don't know. Okay, so that's that one. So my final question, and it's sort of fairly brief answers, is just where the property market is going to be in 5 years' time. Michael, you can start.
Now, don't you all wish you knew the answer to that? I think it's $1 million question.
Because we're all going to invest on the basis of what you tell us.
Well, as you know, because for the introduction, I've been in this industry for 40 years, and so I'm going to just stick with what I know, really, which is that, as David said, as my colleagues have said, we're drastically short of properties. We've got a rising population. I don't see any of that changing. So I'm pretty sure that house prices will rise by 20-25% over the next 5 years. I'm pretty sure that tenant demand will just continue rising. So I'm pretty sure it's a fairly safe place to be investing in property in the next 5 years.
Karen?
I'll second that. Like I said, I've got no clients with big portfolios that are rushing out to sell. The hype going around, landlords wanting to get rid of them for the changes coming in. There's no sign of that at the moment.
Yeah. And again, what I'm seeing, the sentiment is that landlords are not selling, they want more, they're buying more, which to me demonstrates confidence in bricks and mortar as being a good, sound, medium-term investment. So 5 years' time, agree with Michael, I think values are going to continue maybe 5-6% per annum over the next 5 years.
Paul?
Irrespective of in or out, I think 5 years' time and beyond, housing, whether you're buying for residential or whether you're buying to invest, it's a good investment.
Great, thank you very much indeed. Okay, so we have just about, in fact, run out of time. So what I'd like to do at this stage is just thank very much our panel. So Michael Robson, David Westgate, Paul Bamford and Karen Press, thank you so much for really, really useful advice. I would say the one piece of advice I take out of this is talk to the experts, because it's a minefield, isn't it? And you can probably come really unstuck. Equally though, I think you can probably do very well, is what I seem to be hearing. So talk to the experts. Obviously, this has probably produced as many questions as answers, which is a good thing. So you can go onto the Andrews website. I'm sure there are people here you can chat to later on. But the Andrews website has got all sorts of other information as well. Do go on to that. Personally, I'm sure we all agree with this, I'd like to just encourage everybody, particularly I'm an educator, so go and encourage your grown-up children as well to vote one way or another, but let's all go and vote on June the 23rd. Thank you very much indeed.